Hey everybody, Jay here. Welcome to the channel. Big week of earnings this week, and I wanted to take this time to talk a little bit about how earnings impacted my thinking on industrials. But before we do that, let's just take a step back and look at the market. Today is Friday, January 31st, 2020. You can see the Dow dropped over 2%, over 600 points. The NASDAQ and S&P also had pretty similar drops. And it's funny, you take a look at my portfolio, I did hit a bit of a milestone with Amazon's amazing earnings yesterday. I've got my first singular holding that's broken 6 digits. I now have over $100,000 worth of Amazon with 50 shares. We'll see how long that holds up. If we get a serious market correction, I could lose some of that, but I'm fine with that. I have nothing but the utmost confidence in Amazon over the long haul. And what's also interesting, despite this almost $7,000 gain in Amazon on the day, I still lost almost $2,000. You know, Facebook, my number 2 holding behind Amazon, was my most serious laggard in terms of pulling my portfolio down in the short term. But that's another one. I'm fine with that. I'm probably going to be buying into this drop for Facebook, especially if it keeps going. So I hope we continue to see more red with these stocks. Okay, let's jump into the heart of the video now. And what I wanted to talk about was industrials. And the reason I want to talk about industrials is because of 3M. 3M's reported their earnings earlier this week. I have industrials only makes up 1% of my overall portfolio. And the only holding that I have in industrials is right down here is 3M. You can see it's my number 25 holding overall. This is as of yesterday's share price. The numbers document hasn't updated with today's share price yet, but you can see I have a bit under 10,000. It's probably even below 9,500 after 3M dropped another 2% today. And I've been comfortable with 3M being my lone industrial holding, and I've always planned that if I was going to add more to the industrial sector, which I want to do because they represent great income, I always figured it would be adding more 3M, at least for the near term, because they're such a solid company and they represent such solid value. But I can tell you one thing made me rethink that a little bit, and that was I listened to 3M's earnings call earlier this week, but then I also listened to Lockheed Martin's. And what I thought was really interesting, and I'm going to do a big breakdown, I have Lockheed Martin, Raytheon, and 3M all side by side here, but one thing that made my ears perk is the fact that, am I overlooking something by not looking at the Lockheed Martins or the Raytheons when it comes to investing in industrials? And the reason is because it feels like I think that their source of revenue growth, their top line revenue growth, might be in a better place than 3M's right now. And the reason I say that is twofold. Number one, when you break down 3M's earnings, and when I listened to their earnings call, they talked a lot about the fact, you can kind of see it at the end of this article on the street right here. Well, they open it up by saying that they had weakness in sales from their industrial and safety division, which offset gains in healthcare. And overall, their revenue dropped year over year. But you can even see it down here. Industrial and safety fell 4.8%. Transportation and electronics dropped 6.2%, and then healthcare was up by 25.4%. They're still emerging in healthcare. Like they're still, while the industrial, the safety, the electronics, transportation, that is the bread and butter of this company. And what really concerned me for 3M moving forward is they seem to be having issues innovating organic growth outside of healthcare. And I think when 3M starts to become myopically focused within one sector or one business line, that could hurt their business overall. And so I think 3M is going to be fine for the long term. I'm not selling the stock, especially after they have dropped so much recently. That being said, I do think any future industrial stocks that I'm going to buy are going to be more in the vein of a Lockheed Martin. And the reason is look at here. This was Lockheed Martin's revenue report for the year. And you can see that, at least for the last quarter, All four sectors that they operate in, aeronautics, missiles and fire control, rotary and mission systems and space, they had significant gains year over year for the fourth quarter in revenue. And the reason for that, I think, is simple. I think look at the main source of their revenue, and it comes from military spending. And look, this is the total military spending year over year, and you can see this number essentially goes nowhere but up. There's been a few years where it's dropped a little bit. You can kind of see earlier in the century or the decade, it did drop a bit. But look at this now. It went from 767 billion to 818 to 890. 956 estimated for last year, and they're estimating just a little under $1 trillion next year. And so I think that the revenue that that the Raytheons and the Lockheed Martins of the world could get from something as solid and consistent as the large amount of military spending that our government commits to with the budget every year, I think that that represents a better source of growth, top-line growth, than what 3M is positioned for at the moment. And so what I did is I laid these out on a little spreadsheet. I'm going to put this here. So I just laid everything out side by side. This is 3M. This is Lockheed Martin, ticker symbol LMT, and this is Raytheon, RTN. Again, everything's lagging by 1 day, so don't take this data as literal. But a few things jump out at me. First of all, they're all in a similar range for PE, but Lockheed Martin and Raytheon are actually a bit lower and representing a little bit better value. And the other thing too is while 3M clearly has a strong advantage on the overall yield at 3.54%, look at this. Lockheed Martin, from a 3-year CAGR perspective on their dividend, is neck and neck with 3M. And then given the fact that they had 11.25% revenue growth this year. Their past 3 years growth is 8.4%, whereas 3M dropped 1.92% in revenue this year, and they've only grown at 2.2% average annual growth rate the last 3 years. And then over here, if you take a look, their coverage ratio on their dividends is over 70%, while Lockheed Martin is at 43% and Raytheon is at 32%. So this is all my kind of like long-winded way of saying that I think that they have a Lockheed Martin and Raytheon because their main customer is the U.S. military. I think that they are going to be better poised for growth in the future, healthier growth. I'm a little bit concerned about 3M's ability to drive organic growth. And so I'm going to be monitoring these a bit more closely, but I think my next purchase of industrials is going to be Lockheed Martin because of the revenue growth and then the relatively strong dividend. Okay, that's it for today's video. I hope you enjoyed it. And if you haven't yet, please subscribe and you'll be alerted every time I launch a new video. Have a great weekend, everyone. Bye-bye.